Hey, what's up guys? Rosario here. I love cryptocurrency. I have about 20% of my net worth in various cryptocurrencies, including Bitcoin and Ethereum. I've been thinking about a problem that could happen with these currencies for a few weeks now. The best analogy that I can come up with for this is a bank run. So a bank run is what happens when people lose faith in a bank's ability to produce your assets when you go to withdraw them. Bank runs were a relatively common occurrence in the early 1900s, a side effect of fractional reserve banking. Fractional reserve banking is a process by which banks can actually loan out more money than they have in deposits. This basically allows banks to have increased profits because they can earn interest on multiple loans at the same time. It does have a downside in that it increases the risk for the person with their savings deposited into a bank. Here's kind of how it works. So for example, we need a person. Let's call him Kevin. Meet Kevin. He's a guy with some cash, let's say $100, and that $100 is burning a hole in his pocket. He doesn't just want to carry it around with him everywhere, and he's heard that he can actually earn money just by putting his money in a savings account at a bank.
Hey Kevin, come deposit that $100 with our bank. We'll pay you a 5% return on your $100 and we'll give you this IOU. Whenever you want, you can just come back and withdraw your money and we'll give you $100 back in cash. And we'll give you your interest on top of that. If you leave the $100 with us for a year, we'll give you back $105 at the end of the year.
Well, that's great, but why would the bank just pay Kevin to keep his money safe? Shouldn't Kevin actually be paying someone to hold on to all that heavy cash? In a way, Kevin is paying the bank to hold on to his cash. The bank doesn't just keep Kevin's $100 in a box somewhere. What they actually do is they find another person. Let's say his name is Graham.
What's up guys, it's Graham here.
Graham wants to buy a car. He doesn't have the money to buy the car outright, but he thinks that if he can get the money to buy this particular car, it'll go up in value over time and he'll be able to sell it for more than he paid for it in a year.
Hey Graham, we noticed that you need $100 to buy that car. We can loan you that $100 and you can pay us back in a year.
That's great. What's the catch?
Well, you'll have to pay us 10% interest on the loan. So in 1 year, you'll need to pay us back $110.
Okay, well, I think this car will appreciate in value by 15% this year, so I'm good with that.
Great.
Great. So everyone is happy, right? Well, if Graham pays back his loan on time and Kevin doesn't need his money right away, yes, the bank makes a $10 profit off Graham and they pay $5 to Kevin at the end of the year. But what happens if Kevin finds out that all his money actually isn't in the bank after all?
Hey bank, this guy Andre told me that you don't actually keep my money in a safe over there. He says that you lend out my cash to other people and that I might not be able to get my money back.
Don't worry about it, Kevin. We're good for it.
You know, I do trust you, but I'd still like my money back, please.
Well, here's the thing. We don't actually have your $100 right now. We lent it to Graham.
Oh shit. So this example is massively oversimplified, but you get the idea. If the bank loans out all their reserves and then one of their customers comes back asking to redeem their money and the bank doesn't have it, that actually starts a panic. People lose trust in the banks and they go bankrupt. There are many ways that these bank runs can start, but why haven't we seen one of these bank runs in a long time? Well, it really comes down to the Federal Reserve. What the Fed does is they say to the banks, as it turns out, the Federal Reserve doesn't just have big piles of cash sitting around either. So when the bank comes to get a loan, the Fed actually has to create that money out of thin air. The way they do this is by issuing so-called treasuries. Basically, they create a treasury, print the new cash, and find someone to buy the treasury from them. The Fed promises to pay back that treasury loan in a certain amount of time. This is how much of the national debt actually comes into existence. If this all sounds a bit convoluted, that's because it is. Essentially, the Federal Reserve is constantly bailing out greedy banks who want to loan out as much, or more in some cases, money than they have in their vaults. Because of this guarantee from the Federal Reserve, Kevin isn't scared to deposit his money with the bank. He knows that the Federal Reserve will just print money to pay him back if the bank doesn't have it when he comes to withdraw. Obviously, there are some problems with this system, which we'll discuss in a later video. For now, I want to get back to the main point, and that's how this relates to cryptocurrencies. By themselves, cryptocurrencies like Bitcoin don't actually have this issue. It's only when third-party intermediaries come into play. There are a bunch of companies out there that promise to pay you 5% or more on your cryptocurrency deposits. This sounds awfully familiar. In fact, it sounds almost exactly like the situation with the bank. That's because it is. When you deposit your crypto with these companies, they're immediately turning around and lending that crypto to other institutions. That's why they're willing/able to pay you a 5+% interest on your deposited crypto. Here's the problem with these companies from a a crypto investor perspective. Let's say Kevin deposits his $100 with CryptoFi, one of these so-called crypto investing companies, instead of a bank, and they issue him some stablecoin. Tether, USDC, or CRO are examples of these. CryptoFi promises to exchange your crypto one-to-one for US dollars. That's why they're called stablecoins. To simplify it, this can actually happen with Bitcoin as well. Let's say that Kevin deposits 100 Bitcoin with CryptoFi for the promise of 5% interest on his Bitcoin. Kevin later hears the same rumor as before. That is that CryptoFi might not actually have his 100 Bitcoin available to redeem because they lent it out to another company. That company is called Croyager, and that company actually just went bankrupt. Why? Because some other people tried to withdraw their cryptocurrency from Croyager, but discovered that it was lent out to another third party. So because of this rumor, Kevin gets scared. He goes to CryptoFi and says, "Hey guys, give me my 100 Bitcoin back." Well, the problem is CryptoFi doesn't actually have that Bitcoin because they lent it out. Kevin says, "Fine, I'll take whatever you've got." And CryptoFi says,
"We've got 50 Bitcoin here, but that's it. We're bankrupt."
It's not like CryptoFi can just go to the Federal Reserve and get some more Bitcoin to pay back Kevin. Bitcoin is finite. There's no bailout here. So what happens? You probably don't want to know. The reality is that Kevin is shit out of luck. CryptoFi is now bankrupt and Kevin has lost half of his Bitcoin. If this happens on a large enough scale, people will start losing faith in the price of Bitcoin because they don't want to have the possibility of losing a big chunk of it. All that Bitcoin really has going for it in the end is demand. There are no physical assets backing it up. If the demand dries up, Bitcoin's price plummets. Guys, I'm not saying this is going to happen, but it has happened in the past. It has happened time and time again with banks, and even with entire currencies. Famously, hundreds of bank runs occurred during the Great Depression of the 1930s. So maybe it doesn't ever happen and I'm wrong, but I think it could happen. I want you to know that your 5% interest on that crypto trading platform is definitely not risk-free. You could lose everything, and it's not insured. Remember, I'm not a financial professional. I'm just some guy on YouTube, so please don't sue me, bro. Please take what I'm saying and do your own research. Let me know your thoughts. Let me know if I'm wrong and why I'm wrong. I want to learn and get feedback on this. If I'm missing something important, I want to know about it. So what am I doing about this? I'm still bullish on Bitcoin and crypto long term. I think that this issue would largely be localized, and while it could greatly affect the price of Bitcoin and other cryptocurrencies in the short term, Bitcoin, thanks to its limited supply, will be safe in the long term. The best way to protect yourself will be to keep most of your crypto in cold storage. Of course, if the world loses faith in crypto, its value goes to zero. As Meet Kevin recently said, what's the percentage chance in your mind that the world loses faith in crypto? Is it 10%? 50%? Make sure you discount your potential investments in crypto by at least that amount before you make a decision on where to invest. For now, guys, that's all. If you found this video informative, please share it with someone who you think could also benefit from the knowledge and ask them their thoughts. In my opinion, the best way to grow is to share information with others and get their feedback. Talk to you all in the next one. Peace.